Welcome to Cash Talk Podcast.
You know what's wild? Most people spend more time picking a Netflix show than they do thinking about the one financial decision that will literally determine the rest of their life.
And the crazy part, it's not which stocks to buy, it's not which fund manager to trust. It's something way simpler than that, and way harder.
Welcome to Cash Talk Podcast, Episode 5. I'm Ali.
I'm Sara, and this is it, the final episode of our deep dive into the psychology of money by Morgan Housel. And honestly, Ali, I think this might be the most useful one we've done.
Because we're not talking theory anymore. We're talking about what actually works, what you can walk away from this episode and do differently starting today.
Let's get into it.
Before we go deep, two terms that are going to come up a lot today.
First one, volatility. In investing, volatility just means the market goes up and down, sometimes dramatically. Most people treat volatility like it's a problem, like something went wrong. Housel flips that. He says volatility is the price of admission for good long-term returns. It's not a punishment, it's the fee.
Think about it like a flight. Turbulence is not the plane braking. It's just what flying through air feels like. But if you panic and try to get off the plane mid-flight, that's when you actually get hurt.
Second term, room for error. This one sounds boring, but it's actually everything. Room for error means building your financial life with enough cushion that when something goes wrong, and something always goes wrong, it doesn't knock you out of the game. It's the gap between what could happen and what you need to happen to survive.
It's basically never be in a position where one bad thing destroys you. Okay, let's go. All right, Sara, so Housel spends these final sections making a big argument about pessimism. And I think it's worth starting there because it's one of the most honest things I've ever read about how the media and the financial world actually work.
This section hit different for me. So here's what he says. Pessimism sounds smarter than optimism. That's it. That's the whole thing. And once you hear it, you can't unhear it.
Walk me through it.
Okay, so think about it from your own experience. If someone at a dinner party says, I think the economy is going to be great for the next 10 years, markets are headed up, things are looking good, what's your reaction?
Honestly, I'm a little skeptical. Maybe they're naive, maybe they don't understand the risks.
Right. But if someone says, I think we're headed for a major recession, the debt bubble is about to pop, there's a 40% chance of a crash by next year, suddenly they sound like they've done their homework, they sound serious, they sound like they get it.
Even if they're completely wrong.
Even if they're completely wrong. And Housel traces this back to something real in human psychology. He cites Daniel Kahneman on this. Losses feel about twice as painful as gains feel good. We are evolutionarily wired to pay more attention to threats than to opportunities. It kept us alive on the savannah. It makes us terrible long-term investors.
And the media knows this.
The media has known this forever. He points out that the investing newsletter industry is filled with prophets of doom, despite the fact that the stock market has gone up 17,000-fold in the last century, including dividends. 17,000 times. And people are still out here writing "the crash is coming" newsletters and getting paid for it.
Because fear sells. Fear always sells.
Always. He gives this example that I think about all the time now. In 2008, the worst financial year in modern memory, the Wall Street Journal ran a front-page story about a Russian professor who predicted America would split into 6 separate countries by 2010. Alaska back to Russia, California becomes a Chinese protectorate, Texas goes to Mexico.
And this was the front page of the Wall Street Journal?
Front page, most prestigious financial newspaper in the world. None of it happened, obviously, but a forecast of doom that extreme got front-page treatment in a way that no forecast of optimism ever would.
Okay, I want to ask you something real, because somebody listening right now might be saying, okay, so you're just telling me to be optimistic, to ignore risk. That sounds naive.
That's a really fair pushback, and Housel is very clear. He's not saying be blindly optimistic, he's saying be a possibilist. That's actually a term he borrows from statistician Hans Rosling. Optimism doesn't mean thinking everything will be great. It means believing that the odds of a good long-term outcome are in your favor, even while accepting there will be painful setbacks along the way.
And you have to be able to survive the setbacks to get to the good outcome. That's room for error.
That's the whole game. You can be right about the long-term direction and still lose if you can't survive the short-term volatility.
Okay, I want to shift to something that I think is genuinely underrated in this book, and that's the section about bubbles, financial bubbles, and why smart people keep getting trapped by them.
This is the section where Housel basically exonerates everyone who got caught up in the dot-com bubble and the housing bubble, not because they were right, but because, again, they weren't crazy.
Explain the mechanism.
So here's the insight. When a financial asset is rising fast, stocks, real estate, whatever, you have two completely different types of buyers in the same market. You have long-term investors who are buying because they believe in the fundamental value of the asset over 10, 20, 30 years. And you have short-term traders who are buying because the price has been going up and they plan to sell before it goes down.
And those two groups are playing completely different games.
Completely different games. The short-term trader doesn't care that a house isn't worth $700,000 based on 30 years of rental income. She's buying it to flip it in 6 months when the price is $750,000. That math works for her game. But if you're a long-term buyer sitting next to her in that market and you buy the same house that's $700,000 expecting to live there for 20 years, you just made a terrible decision. Same price, same asset. Two completely different outcomes.
And the problem is, you can't always tell which game someone else is playing.
You almost never can. And the price they're setting in the market looks the same to you whether they're a day trader or a long-term investor. So long-term investors look at the price short-term traders are paying. They think, well, they must know something. And they get pulled in. That's how bubbles trap rational people.
And this goes way beyond investing. He connects it to consumer behavior, too.
Right, and this is the part that really got me. He says something like, so much of consumer spending is socially driven. You look at the lawyer next to you buying a nicer car, a bigger house, sending his kids to a fancy school. You don't know his income. You don't know his goals. You don't know his time horizon. You just see what he buys. And your brain, without even realizing it, starts calibrating your own expectations to his behavior. But he's playing a totally different game than you are.
That's actually kind of uncomfortable to hear.
Right? Because we all do it. Every single one of us. We're constantly benchmarking ourselves to people we see in real life, on social media, everywhere. And we have no idea what game they're actually playing, what it cost them, what they sacrificed, what they owe.
And the advice Housel gives is almost radical in its simplicity.
Write down your game. Literally, physically write out what you're actually doing with your money and why. What's your time horizon? What are you optimizing for? Because once it's written down, everything that doesn't fit your strategy stops being relevant to you. You hear a stock tip on CNBC, and instead of getting anxious, you can say, that person's playing a different game than me, and move on.
Okay, let's talk about the section that I personally found the most useful, maybe in any book I've read about money. And that's when Housel stops talking about principles and just tells you what he actually does with his own money.
Yes, this is where it gets real.
Because all the theory in the world doesn't mean anything if the guy writing the book does something totally different with his own money. And Housel is shockingly honest here.
Shockingly. So what does he actually do? He and his wife live well below their means. They established a lifestyle when they were young and basically kept it the same even as their income grew significantly. Every raise went to savings, not lifestyle upgrades.
And he calls their savings their independence fund. Not a retirement fund, not a college fund, just independence. The ability to wake up and decide what they do next.
Which he traces back to watching his father, who was an ER doctor, one of the most stressful jobs imaginable, just quit one day when he'd had enough, because they had savings, because they had options, the freedom to walk away from something that wasn't working anymore. That was the whole goal.
Not to be rich, to be free.
There's a line Housel quotes from Charlie Munger that I keep thinking about. I did not intend to get rich, I just wanted to get independent. And Housel basically says, that's the goal. That's always been the goal.
And then he tells you something that is, by his own admission, financially irrational.
Yes. Okay, so they paid off their mortgage fully. no mortgage, in a period of historically low interest rates when any rational financial advisor would tell you, keep the cheap mortgage, invest the difference in index funds, you'll come out ahead mathematically.
And Housel knows this. He says it explicitly. He calls it the worst financial decision we've ever made.
But then he says, and the best money decision we've ever made.
What's the difference?
A financial decision is the one that maximizes returns on a spreadsheet. A money decision is the one that you can actually live with, that lets you sleep at night, that doesn't create anxiety, that doesn't make you feel exposed. And Housel is making the argument that those two things are not always the same, and that's okay.
And this connects to one of the bigger rules he lays out in the All Together Now section. He says, manage your money in a way that helps you sleep at night. That's the standard. Not highest return, not most aggressive strategy, sleep.
Because the best financial plan is the one you can actually stick to. A slightly suboptimal strategy you follow for 40 years beats a perfect strategy you abandon after the first crash.
That's the whole game.
And he keeps almost everything in index funds. Low cost, no stock picking. He says there's very little correlation between investment effort and investment results because markets are driven by a tiny number of events that account for almost all the returns, and nobody can reliably predict those events. So the best move is usually to own everything, pay almost no fees, and wait.
Boring, unglamorous, effective.
Aggressively boring. And he's completely unapologetic about it.
Let me throw out the list he gives, because I think this is the most practical section of the entire book. He just lays out the rules. Fast, direct.
Let's do it.
First one, less ego, more wealth. The gap between what you earn and what you spend, that's your savings rate. And your savings rate is directly tied to your ego. The bigger your need to look wealthy, the smaller your actual wealth. Because wealth is what you don't see. It's what you didn't spend.
Second, increase your time horizon. This is the single most powerful thing a regular investor can do. Time is the force that turns ordinary savings into extraordinary wealth. Not genius, not timing the market, just time.
Third, be okay with a lot of things going wrong. He says you can be wrong half the time and still build a fortune because a small number of good decisions account for most of the upside. The goal is to not get knocked out of the game before those good decisions have time to pay off.
Fourth, and this is the one that I think most people don't want to hear, use money to buy time, not things. He says the highest return in all of finance is the ability to do what you want, when you want, with who you want. That's it. Not the fancy car, not the big house. Time, control, autonomy.
And the research backs this up. Study after study on happiness shows that people with more control over their schedule, even if they earn less, report significantly higher life satisfaction than people with higher incomes but no freedom.
Fifth, save for things you can't predict. He says everyone's life is a continuous chain of surprises. Savings that aren't earmarked for anything specific, that's not lazy financial planning. That's the most important financial planning, because the thing that will require that money is, by definition, something you can't see coming.
And sixth, one of my favorites. Be nicer and less flashy. He just says it directly. Nobody is as impressed by your possessions as you are. You want a luxury car? What you actually want is respect, and you're more likely to earn respect through how you treat people than through what you drive.
The audacity of a personal finance book telling you to just be a better person.
Right? And he's not wrong.
Okay, I want to close with something that I think reframes the entire conversation about money and honestly about life, because Housel ends the book with this long look at the history of the American consumer, how we got to the place where people are buried in debt, comparing themselves to people they'll never be, buying things they can't afford to impress people they don't like.
And the answer isn't what most people think.
It's not greed, it's not stupidity, it's expectations that got set in one era, the 1950s, when incomes were actually rising equally, when a factory worker and a lawyer could have pretty similar lifestyles, and never updated when the economic reality changed.
People's parents told them, work hard, buy a house, keep up with the Joneses, and you'll be fine. And that was true for a generation. And then the income inequality shifted, and the lifestyles of the wealthy exploded, visible on TV, then on the internet, then on Instagram. But the expectation that everyone should be able to live that way stuck around.
So people borrowed to fill the gap between their income and their expectations. And that gap keeps getting wider, and the debt keeps getting heavier.
And understanding that, really understanding that your financial behavior is partly a product of expectations formed by a world that no longer exists, that's maybe the deepest insight in the whole book.
Because once you see it, you can choose differently. You can ask, what game am I actually playing? What does my life need to look like for me to feel okay? Not what does Instagram tell me it should look like, not what my parents expected. What do I actually need?
And for most people, the honest answer is way simpler and way cheaper than what they're currently chasing.
Way simpler, way cheaper, and way more available than they think.
Here's the question we want you to actually sit with this week, not think about, sit with.
Here's the question we want you to actually sit with this week, not think about, sit with.
What would your financial life look like if you stopped playing other people's games?
If you stopped benchmarking yourself to people whose income, debt, and goals you don't actually know.
What would you stop buying? What would you stop worrying about? What would you start doing instead?
Write it down. That's the assignment. Seriously, write it down.
If this series added something to how you think about money, share it. Send it to someone who needs it. Leave a review. It genuinely helps us keep going.
This is Cash Talk Podcast. I'm Sara.
I'm Ali. Take care of your money and take care of your mind.